How did Bernie Madoff's $65 billion scheme evade SEC scrutiny for 17 years? Bernie Madoff ran the largest Ponzi scheme in history for at least 17 years, defrauding 4,800 investors of $65 billion, and the SEC investigated him 6 separate times before he turned himself in. To put this staggering figure into perspective, consider that the total amount of U.S. government debt outstanding in 2008 was roughly $9 trillion. Madoff's scheme alone accounted for a staggering 0.7% of global GDP at its peak. But what exactly did Bernie do with all these funds? The short answer is, he used it to fund his lavish lifestyle and support other related business ventures. But the story gets even more complicated when we dig deeper into how this scheme managed to last for so long. We'll explore the details of his operation in later chapters, but first let's take a look at what set off alarm bells and ultimately led to his downfall. So how did Madoff promise his investors returns of 10–12% per year with minimal risk? He used a complex financial instrument called the split strike conversion, or SSC. It's not an investment strategy in itself, but rather a way to package and sell other investments. Imagine buying a call option on IBM stock and simultaneously selling a put option with the same strike price. That's what Madoff did, except he traded these options for S&P 500 futures contracts instead of individual stocks. But here is the thing. The split strike conversion isn't inherently complex or hard to understand. It's just a way of hedging against market downturns by buying protection and selling insurance at the same time. So, how did Madoff make this strategy into a guaranteed return? That's what we'll explore next. Madoff used these SSC trades to create a layer of protection for his investors against market downturns. But in reality, he was using the same funds from newer investors to pay off earlier investors, creating a Ponzi scheme on top of the split strike conversion strategy. As we'll see later, Madoff's consistent returns were an early warning sign that something was amiss. But for now, let's focus on how he promised his investors they could earn those high returns with minimal risk using this supposedly sophisticated strategy. The split strike conversion strategy was a key part of Madoff's pitch to attract new investors and reassure existing ones. It sounded complex enough to be convincing, but simple enough that anyone could understand it. But here is the thing. Behind the scenes, Madoff was using his SSC trades as a way to hide the true nature of his scheme. He used them to disguise the fact that he was simply moving money around and paying off earlier investors with newer funds. As we'll see later, this strategy ultimately led to Madoff's downfall in 2008 when the market began to fall apart. But for now, let's focus on how he used it to convince his investors that they were making safe investments. So let's turn our attention to a key figure in this story who almost single-handedly kept the Madoff Ponzi scheme going for years: Harry Markopolos. In 2000, Markopolos submitted a 19-page memo to the SEC detailing suspicious activities and warning that Madoff was running a massive Ponzi scheme. But before we get into what exactly was in this memo, let's put ourselves in Markopolos' shoes for a moment. He worked at Bear Stearns, but he was also working as an independent consultant on the side. And it was through this consulting work that he became aware of Madoff's operation. Markopolos had been looking into Madoff for several years by then, and what really caught his eye was the extraordinary consistency of Madoff's returns. You see, most investment managers have good months and bad months. They might make 10% one year and lose 5% the next. But not Madoff. His returns were eerily smooth, like a perfectly tuned machine. Markopolos was particularly concerned about how Madoff seemed to be manipulating his clients' trades to create these consistent results. He noticed that Madoff's firm was selling call options against its own portfolio, and then buying them back at the same time, essentially creating a self-sustaining machine that generated steady profits. So what exactly did Markopoulos write in his memo? Let me give you a quick rundown. He detailed several red flags, including Madoff's consistent returns, his suspicious trading practices, and the fact that he seemed to be paying out more than he was taking in from clients. Markopoulos' memo was a masterclass in due diligence, but unfortunately for him, it fell on deaf ears. The SEC ignored his warning and instead chose to investigate Madoff's operation, which only led to further cover-ups and deceit. In the next chapter, we'll explore how the SEC repeatedly dismissed Markopoulos' warnings and failed to take action against Madoff. It's a story of bureaucratic incompetence, regulatory capture, and ultimately catastrophic failure. But first, let's pause for a moment and reflect on what Markopoulos did right. The SEC's repeated dismissals and failures. So what did the SEC actually do during those 6 investigations? The agency received several warnings from Harry Markopoulos, but they were consistently dismissed as not actionable. One reviewer called Madoff's operation legitimate and said that there was no reason to go further. The first warning came in 2000. Markopoulos had been hired by a hedge fund to investigate their trading strategy. He discovered that the returns on the funds seemed unusually consistent, almost too good to be true. When he questioned the manager about it, they simply said that they were following a proprietary strategy and didn't want to discuss it further. The SEC looked into it briefly, but ultimately decided not to pursue any action. Over the next few years, Markopoulos continued to gather evidence, documenting over 100 red flags in Madoff's operation. He submitted a memo to the SEC in 2005 detailing his findings and recommending that they investigate further. But again, the agency chose not to take action. It wasn't until 2008, when the economy was already reeling from the housing market collapse, that the SEC finally began to seriously look into Madoff's operation. By then, it was too late. Millions of dollars had been lost, and many investors were left destitute. In hindsight, it's clear that the SEC failed miserably in its duty to protect investors. The agency's repeated dismissals of Markopoulos' warnings and failure to investigate further allowed Madoff to continue his scheme for years longer than necessary. Madoff promised investors returns of 10–12% per year, which sounds suspiciously good. But let's put it into perspective. In the early 2000s, you could get a high-yield savings account at your local bank that paid around 4–5%. Why would someone take on more risk with Madoff's investment strategy when they could earn a steady return elsewhere? And yet, hundreds of investors continued to put in their money year after year. The key to Madoff's success was his ability to deliver consistent returns. He claimed that his strategy involved using complex computer algorithms and trading techniques to generate these high returns. But there are several red flags here. First, no one outside of Madoff's company really understood how he made his money. Second, the returns were always remarkably consistent. It's as if Madoff had a magic formula that never changed. We know now that this was all part of the Ponzi scheme. Madoff used some of the new investments to pay off earlier investors, which created the illusion of steady growth. But it's also worth noting that many of his clients were wealthy and sophisticated investors who should have known better. They ignored their own financial advisors' warnings because they wanted to believe in Madoff's promise of guaranteed returns. In hindsight, the giveaway here is not just the unusually consistent returns, but also the lack of transparency about how those returns were generated. Any investment strategy that promises guaranteed success with minimal risk should be viewed with suspicion. The fact that Madoff was able to dupe so many people for so long is a testament to his charisma and the allure of easy money. So let's get back to our timeline and examine what happened in the summer of 2008. You might remember that this was the height of the financial crisis, with Lehman Brothers filing for bankruptcy in September 2008 and global markets plummeting. Madoff's investors were getting nervous, but they were also eager to get their money out. This is where things get interesting. In the second quarter of 2008, something strange started happening. Investors who had been quietly enjoying Madoff's consistent returns suddenly decided it was time to cash out. Now, this in itself wasn't unusual. Investors regularly withdraw their funds from various investments. But what made this different was the sheer scale and speed at which these redemptions were happening. In fact, according to Madoff's own records, the rate of withdrawals between May and July 2008 was nearly 4 times higher than it had been in the previous year. This is when the problem started to cascade. You see, Madoff's scheme relied on new money coming in to fund existing investors' withdrawals. But with so many people trying to get their cash out at once, the system began to break down. The funds simply weren't there to meet the demand. Madoff's operation was built on quicksand. He had been promising his clients unusually consistent returns for years, but in reality, he had no actual investment strategy. It was all just smoke and mirrors. And now that the redemptions had reached a critical mass, the whole house of cards came crashing down. On December 11, 2008, Madoff's secretary, Annette Bengirno, alerted him to the fact that there was no more money available for withdrawal. It was over. The scheme was exposed, and within weeks, Madoff would be arrested and charged with running what is widely regarded as one of the largest Ponzi schemes in history. So how did investors recoup their losses after the Madoff scheme collapsed? The answer lies in clawback litigation, a massive effort that recovered billions of dollars for victims. But before we dive into that, let's clarify what exactly clawback means. In finance, a clawback is when someone, in this case, investors who profited from the scheme, has to return money they received. It might sound counterintuitive. Why would anyone want to give back ill-gotten gains? But here's the thing. Many of these investors, including some high-profile ones like JP Morgan Chase and UBS, had knowingly or unknowingly invested in Madoff's funds. They took their share of the profits while others lost everything. The clawback effort was led by Irving Picard, a court-appointed trustee tasked with recovering as much money as possible for victims. His team scoured through financial records and identified billions of dollars in assets that had been secretly siphoned off from the Ponzi scheme. The idea behind clawback was to unwind these transactions and return the money to its rightful owners. One key example is the recovery of hundreds of millions of dollars from Fairfield Greenwich Group, a hedge fund manager that invested heavily in Madoff's funds. They claimed they were unsophisticated investors who didn't know any better, but it turned out they had received unusually high returns for years, returns that far exceeded what their own investment strategy could possibly justify. The takeaway here is that the recovery effort was not just about punishing those who profited from the scheme. It was also about restoring justice and fairness to victims who lost everything due to Madoff's actions. The clawback litigation process took years, but ultimately recovered billions of dollars for those affected by the Ponzi scheme.